So I want to take you back to this little area right here. And I really wish there was a way for me to highlight my cursor. So I'm going to move very, very slowly so that way you can track it. The largest chart we're looking at here is a 1 minute chart. Okay. And the lower left-hand chart here is a 5 minute chart. And the upper left-hand corner is a 15-minute time frame. When you're trading, it's important for you to have not just one single time frame. You're going to execute on one time frame. You're going to have all of your analysis built on a higher time frame chart. That would be, in this case, if we're going to be scalping, because I'm attacking the idea that you can't make money scalping. You absolutely can eviscerate the majority of what everybody else thinks is a good return. You can literally do that every single day. Scalping you can do every single day. There isn't a day that you cannot go into the marketplace and not make money trading as a scalper. You absolutely can do that. The problem is you're going to go in and try to do it more time than is necessary for you. If you go in and you made $2,000, you're going to feel really good about that. And it's going to feel like, wow, I want to spin the wheel again. I want to throw the dice once more and get that feeling again. And that's what you have to fight as a trader. You have to fight that urge to do that. And as a scalper, you can go in there and go insane, make lots of money, have a long series of winning trades, and then do something stupid, regret doing that, try to get it back, and it turns into blowing your account, going into severe drawdown. You've seen YouTubers do this. You've seen influencers come out and be honest and say this is what they're plagued with. And I'm trying to help you if you listen. But you have to have multiple time frames that you're going to be referring to. I'm going to drop down below a 1 minute chart too to show you the significance of what price is doing on these lower time frames, sub 1 minute. Every single hour, there's an opportunity for you to scalp. Every single 15-minute interval, there's an opportunity for you to scalp. Now, the problem is, and I found this out to be true for myself when I first tried to do scalping in the bond market in the 90s, I could see these moves on the very small time frames, and then I would get married to the idea it was going to give me more than what I subscribed to or framed for my trade. And what do I mean by that? Let's assume for a moment that we were looking at these lows down here on the 1 minute chart. Okay. And let's assume that we were considering how the market is recently trading at all-time highs. And I'm going to address that here because it's also a question that keeps coming up a lot still, even though I answered it in my comment community section on my YouTube. When a market trades into all-time highs, I am completely in the same category as every other trader. I don't know what it's going to do. I don't know how far it's going to go higher. You don't know how far it's going to go higher. You don't know when it's going to stop. You don't know if it's going to reverse. No one knows that, folks. No one knows that. So it's a very interesting condition to be in as a trader because I know lots of things in how to trade inside of a range, outside of a range, but at all-time highs, I have no tools. I have no tools. I have a blank canvas in front of me, and I have to wait for the paint to be applied to the chart. I gotta work with what it gives me. And in my mind, this is the way I interpret it. Since we traded to all-time highs, I don't want to go against that. So I will look to take buy signals until those buy signals prove to me, not just by one losing trade, not by two losing trades, but if I go through a series of several days in a row, and if I'm buying and it's failing and I'm going in drawdown, and yes, I can go into drawdown. This is exactly where I would incur it because I'm in a discovery, just like you are, of whether or not the market is going to allow for prices to go higher. Now, with that premise, we can see that we are in 7 o'clock in the morning. So 7 o'clock is the New York kill zone. So at 7 o'clock in the morning, I can start looking for setups in any market. And I said this before, but it goes over the heads of some of you because you're not really doing too well in terms of taking notes. There are things that I'll talk about that are specific to Forex, and there are things that I say that are specific to futures. And unless I say that at the time of me teaching it, everything I say is universal. That's my belief, okay? So at 7 o'clock in the morning, that starts the New York kill zone. So if we have that, delineated. Sometime after 7 o'clock, I'm bullish. Why? Because we traded at all-time highs. I don't want to try to pick the top. I don't want to be a sucker and try to, do something that's impossible. So I want to look for areas where the retail trader that wants to sell short or try to pick the top, or aggressive traders that think they're going to outsmart the marketplace, they're going to buy early. And by buying early, they'll place a stop loss below a low that forms just after 7 o'clock in the morning. So here's 7 o'clock. We have a low. We went lower here, but see how shallow that was? You see that? Does that imply a continuation the rest of the day? Probably not. And as we get closer to 8:30, 8:30 is usually a turning point, because whether there's news or not, and there really isn't any news of any significance until 10 o'clock today. Some kind of manufacturing index number or something. And we'll get to that when we get into 9:30 going into 10 o'clock with the opening range. But this low here, this run here, it runs to this high to take out the liquidity. This low takes out the liquidity below here and here. But this is what's going on every single day. The market will trade to liquidity for the purposes of stopping out people that would be profitable at a later time when the market does run. So what is our bias today? It's the bullish bias. We're not trying to pick the top on the daily chart. So we're focusing primarily on being long. When do we start looking at the charts? At 7 o'clock in the morning. It starts the New York session. Do you need to be in front of the charts at 7 o'clock? No. Can you start at 8:15 and wait for 8:30? Yes, that's a good time too. You're not locked into that, because I just told you at the beginning that every single hour you can scalp. Every single 15 minute there's a scalp. Every quarter part of 1 hour there's a scalp. But it isn't going to run 100 handles all the time. So you have to strip it down. So what's the minimum that I would like to see for trading and scalping the NASDAQ? It's 10 handles. If I can't at least make 10 handles, and I'm going to tell you how to determine that, okay? But if I can't make at least 10 handles, I'm not willing to take the trade. I don't care. I'll let it go. And there's lots of setups that I see all day long intraday, if I'm in front of the charts, that I will say, okay, I think it's going to do this, but I don't want that one. And I'm going to tell you how to determine that today. This is one of those lessons where you have to let me talk, but I promise you're going to see it, because I'm going to show it to you in charts real time. But if we don't have an expectation of what we're focusing on going in, we're wasting our time here today. And I can push buttons in front of you and make all kinds of pseudo profits, and you'll leave knowing nothing. And that's not why I'm here. I could keep going back and making videos of me doing executions and showing you that way. And that's fascinating. It gives you study homework. But I'm here to teach it today. So if we look at how the market dropped down and it took out these lows here, see how they're relatively equal? See right there? I'm going to take this vertical line off because it's a little too aggressive. When we see that low right here on the 5-minute chart, see it right here, right above my cursor? That is this low right there. Okay. Go to the left of that low. What do you see? That's a down close candle. That is an order block. Friends and neighbors, that's not a supply and demand zone. Okay? It's not. What this is a candle that is opposed. It's closing lower. So it's a down close in a market that's predisposed to go higher. Why should it go higher? Well, go up one time frame from the 5-minute, and it's the 15-minute. What's right here? See these smooth highs right here? I'm going to annotate that. There. Okay? So you see this high right there? Look where it goes to. It goes right there, stops, and comes right back down. And does what? It unsettles the longs that had a stop loss right below that low right there. And then the more prominent run takes place. And it's reaching up into this high. So on a 15-minute time frame, whether I'm scalping or whether I'm day trading for the full daily range or if I'm short-term trading, regardless of whatever I'm doing, I am always referring to the 15-minute time frame as my bellwether time frame. Because on the 15-minute time frame, let me maximize this real quick here. On the 15-minute time frame, this is going to give me all of the salient points of liquidity that I believe is going to be pertinent to the session that I'm going to trade or about to trade. And it also will have the built-in advantage of showing me the daily levels that I'd be interested in if I'm going to trade the full daily range. If I want to get the lion's portion of that full daily range, whether it be an up day or a down day, I can determine those points of liquidity, whether it be buy side or buy stops, or sell side or sell stops. I can clearly and easily see them on the 15-minute time frame. And I can also see all of the pertinent imbalances, whether it be a sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency, meaning a fair value gap with an up or down close. And right now, when we see price here, afford me the ability to talk about this because I did an execution before we started, and I'm going to walk you through that. That's what I'm doing here. And then I'm going to do another one after I go through that. And then at 10 o'clock, I'm going to do another one live right in front of you. I'm going to put the trade on. I'm going to put the stop loss on. I'm going to talk about every single candlestick that I believe is going to paint after that. But allow me, okay? Allow me the floor to do it like this, okay? If we see this setting here on the 15-minute time frame. Now think, we start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? Folks, I would have paid money for someone to teach me what I'm going to show you today. And you're getting it for free. That's worth a thumbs up. All right, between 2 o'clock and 5 o'clock in the morning, that is the London Open kill zone. Why is that thing taking forever to make a box? There you go. So from 2 o'clock to 5 o'clock in the morning, what's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. I'm not a breakout trader. We'll talk about breakaway gaps today too, by the way. The idea of focusing on a bias that is bullish on the daily chart, weekly chart, and monthly chart, we're expecting higher prices. We're not resisting the likelihood of higher prices and a new all-time high on NASDAQ. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Is price dropping? Yes. Is it dropping to some random level? No. Look over here. Below that low is going to be what? Sell stops. So traders that see this low and break below that and it's consolidating, someone's going long there. I don't need to know who it is. There's always going to be buyers and sellers. Always. But that buyer or seller pressure is not what causes the markets to go higher or lower. The markets are absolutely rigged. They're engineered to go higher or lower because whatever the market is in fact trying to reach for, buyers or sellers, they're not pushing it there. The market's going to go to where the liquidity is, and it will keep repricing until it gets there because it's a game that's controlled by them, quote unquote. Okay. If you understand that and just warm up to the idea that it's rigged, initially it sucks when you think about it because you think, well, I have no chance. But when you realize it is rigged, now you do have a chance because it's rigged. It's not random then, right? So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, most time. Between 2 o'clock and 5 o'clock in the morning, London will create the high or low of the day, whether it be Forex, whether it be index futures, it doesn't matter. This is a truism. Do not take my word for that. Go into your charts and study it. Now, because it does that very thing here, right at 3:30, and that's an interesting time because if you go through my private mentorship core content lessons right on this YouTube channel for free, you'll hear me even teach about that right there. And that's the low of the day. Now, when it creates that low, we want to see some kind of displacement to the upside. Because if it does do that, that's indicating the algorithm is flashing like a billboard sign to smart money who trades on it. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high, because right above short-term highs is going to be what? Buy stops. And or a fair value gap above market price. Okay, so if we went down here, where is there a old high and where is there an imbalance? Well, between this low here to this candle here, what is that? That's an imbalance. It's a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI, sell side imbalance, meaning it moved predominantly more to downside, and it's inefficient in its buy side delivery, meaning since it's one big candle that went down and closed lower, you want to find the previous candle to it and the candle after it. Those are the range extremes that you're annotating. So down here when it hit the stops, first thing in my mind is, okay, how do we trade after that? And it should go into this gap here, which is being shaded. Does it do that? Absolutely it does. Then it creates what? Another gap here. This is a buy side imbalance, sell side inefficiency, because it's a fair value gap that has an up close. So while I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. So I'm looking at it like a rock climber would, okay? I look at this entire drop here as a rock or cliff on a rock. And I want to climb all that. I might not be successful making it all the way up to the high or to the zenith of it, okay, the top of it. I might not be equipped to be able to get there, but I might be able to climb up high enough and get the memory or the visuals or maybe a picture of being at that point. Well, in that case, it's here, which is what I mentioned earlier when we were looking at price action on the 1 minute chart. But when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. So what's above that? Another gap. We'll get to that in a minute, okay? But the market rallies up and it leaves this imbalance. Okay, I'm going to move this box over a little bit by one so that way we can see. And I'm going to zoom in also. I promise you folks, this is exactly what's missing from you watching price action live. When you start looking at it like this, I promise everything will start clicking. And it'll feel like it's illegal for you to know what you do. So this buy side imbalance, sell side inefficiency, I'm annotating the high of that candle and the low of that candle. And I'm focusing on the range between those two price points on this candle here. So when you see me putting rectangles on my chart, that's not a supply and demand zone. I'm looking at how this offered buy side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside or offer it through sell side delivery. This is buy side delivery when price is expanding higher. This is sell side delivery when it's offering price as price is dropping. Since I seen it price drop down here, and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. I don't need to. I don't need to be awake. In fact, I wasn't to see this. If I was awake at the time, I would have went long in here. And then I would have pyramided in here and added more. And then I would have pyramided right there where you're going to see where I entered. This is the only trade I took today so far with this paper trading account. This right here, we're going to get into that in a minute. We'll go back to this for a second. So think about it. It goes down here to take the stops on a day when we're bullish. Okay, wonderful. Does the market immediately react by going higher after it goes below that low? Yes, it does. And also notice where the bodies are. See, the wicks they're trading down and past that low. That's the damage. The bodies are telling you, it's like if you were at a card game, okay, and you had a confederate working with you, someone that's going to cheat the game with you, and you're trying to beat the players at that other side of the table with you, and nobody knows that you're in cahoots with the guy across the table or the dealer. They may flash their cards, okay, and tell you, this is what I'm playing with. Well, that's the equivalent of what's going on here with these bodies. You see where the close of this candle is here? Yes, this candle went all the way down there, but then closed right there. And then this candle opened, went all the way down here, past that low again, and then closed right there. And then we opened on this candle and tore off. That to me, listen folks, listen. This is where you're supposed to be writing things down. If not, at least put down the time marker. Just hover over top of the little window down here. It tells you what minute marker this is. And write this down, okay? How do I know when to trust a fair value gap? Well, first I have to have a bias. Okay, am I bullish or bearish? Because the narrative is going to build the idea of whether or not I'm going to be bullish or bearish. The bias cannot be derived until you at least confer with what the present narrative is. And the narrative is what I've been talking about. The market is long-term bullish. We're at all-time highs. Avoid trying to pick top. Now, take that part out of the equation, okay, because we're not always going to be trading at all-time highs. Okay, just take that away. If we're bullish on the weekly chart, you think the weekly chart's going to go higher. It's the same thing, folks. We're not reinventing anything. I'm not complicating anything. This is my approach to teaching you how to trade using my concepts inside of a live stream for 3 hours. I promise you, you're going to leave today knowing how to do this stuff. You may not fully understand it at the time in first viewing, but you will have everything in your hands. You don't need to buy my books. You don't need to have to come back to my YouTube channel after this. Okay? I'm literally putting it in your hands. If my son or daughter said, ICT Daddy, can you please tell me how to do this as short as you possibly can and go right in and start making money? This is it today. This is it. Okay? But none of you are really going to consider that because you don't want to hear me talk. But the body's respecting the fact that it didn't close below that low. That tells me that this was a stop raid. So what does that really answer? Well, it answers, how do you know it's going to not go through that low and keep on going? I don't know in the first candle. I want to wait and see when it closes. It closes here. Then I want to see the next candle. What does it do? Does a little movement below that, but then the body stops there. What is that? That candle's closed right there. What is that? That's a swing low. Go back and look at the videos. That's a swing low. At a time when I'm bullish, at a time of the day when it creates the low of the day, if I'm bullish, it's knocked out traders that are long that had sell stops below that. So we crossed all boxes off that this is a high probability reversal in a day that's likely to go higher. You see how all these things come together like a dovetail. It's beautiful. It's perfect symmetry. If you wake up at 8 o'clock in the morning, 7 o'clock in the morning, anytime before the opening bell at 9:30, I look at the overnight session and see what it did like this. I look at London's trading from midnight to the London Open. And my London Open kill zone is 2 o'clock in the morning to 5 o'clock in the morning, New York local time. I don't care where you live, where you are geographically. If your charts are not set to this right here, you cannot learn properly from me because you're going to try to apply your local time wherever that is, and it's going to mess up everything. And plus, you're going to be trying to send me messages through TradingView or leave me comments in my videos saying, I'm looking at this candle at that time, and your time is your local time, not the time I'm referring to it or relative to New York time. Everything algorithmic runs on New York time. I don't care what anybody tells you. That's what it does. That's what it does. Okay? So back to this. How do you trust fair value gaps are good for longs or shorts? Or in this case, we're bullish. And we do see the signature that we did run stops, and this candlestick closes above the low that was taken out for stops. So that right there is my first indication that that's a very high probability reversal point. But I don't need to buy it yet. I don't need to buy it yet. You don't need to buy it yet. Ego says you need to buy it there. You don't. You wait for the next candle. Does it create a swing low? Yes. What is a swing low? A swing low is a candlestick that has a low right here, right above my cursor. And then the low that takes out that liquidity below that low over here. So we have a lower low on that candlestick. And then the next candle, when it closes, has a higher low than this candle here. So what we're saying is a swing low, if you'll allow me to draw a real quick, crude depiction of it. Don't worry about the colors because that's not significant here. But a swing low is this. It's any swing point in price. When the price swings up and it makes some kind of a turning point and starts to move lower, the opposite would be seen here like this. Come on. That's a swing high. A swing low is that. Okay, it's 3 bars, 3 candlesticks. And the length of these, okay, this has no bearing on anything. It could look like that, or it could look like this. You just need to have 3 of them, okay? That's also part of Power 3. It'll be in the book, trust me. Oh, you're a tease, ICT. Well, I got to do it somehow, right? I got to get you worked up. And a swing high could look like this, where the first high of the 3 bar candles is lower than the highest one and still lower than the third candle's high. Or it could look like this. As long as there's 3 candles with a candle to the left with a lower high and a candle to the right with a lower high than the highest one, that's a swing high. It doesn't matter if this high is higher or lower than this high. It doesn't matter. You just need 3 of them to cause a turning point. So when I see that in price action, it gives me confidence to trust that was a raid on sell side below that low here. And then the highest probability trade is to wait to see if there's displacement. That means I'm letting it, or let me properly phrase this. If I had been awake, I would have allowed for this move to occur and then tried to buy something down here. But let's say I didn't get it. Say I missed it, or I walked away from my computer and I missed the ideal entry. Then I'm going to wait. I'm going to wait for this right here. I want to see it dig up into this. And this is going to be very hard for me to have this on the chart because there's a lot of stuff going on right now. Remember, this is the sell side imbalance, buy side inefficiency between that candle's low and that candle's high. Let me take this off for a second. I want to see it run up into these extremes from here to here. I want to see how it trades there. Does it trade all the way up to and close above halfway? Halfway what? This gap. So if we take the fib and measure that, here's 50% of it. Does it close above that? Yes. So what does that tell me algorithmically? That it's going to use this imbalance here, okay? It's going to use that as a draw on liquidity. And now I want to see it do what? Work its way back down into this gap from this candle's high and that candle's low. This gap right here, I'm only going to refer to it in terms of its consequent encouragement, which is the midpoint of that gap, the 50%. And I would use that on a lower time frame chart to see if it's going to offer me an opportunity to go long. But it's already fulfilled its role here by drawing price up. So what does it tell me at that point? It tells me that, okay, this was a stop hunt. The market does what at that point? It's going to seek inefficiencies above price. Well, it did that quickly here. Where's there other inefficiencies? Right in here. And where are the buy stops? Above that high, and it's relative equal highs rather. So there's buy side above the market right there. So those buy stops, once these sell stops have been taken, smart money does this. It buys sell stops and sells to buy stops. You see what it did here? It went below that low, accumulated long positions with willing bodied sellers at a low price. Why? Because somebody went long here. Do I need to know how many, and who it was? No. You don't either. You don't need a book map. You don't need a ladder. You don't need depth of market. You don't need all these things people say, oh, you're tape reading. Show me what you're doing with level 2 data. You don't need any of that stuff. I know what these markets are doing. I'm teaching you how to do it without any gimmicks, nothing. You have nothing to add to these charts. You just need to know what time it is. And they can't hide it. They cannot hide the liquidity that will be above here. They cannot hide the inefficiencies that the chart will absolutely draw attention to. You have to have a time-based chart. Anyone that tells you that time-based charts are useless, they're ignorant. They're ignorant. They have no idea what they're talking about because price moves on the basis of time first. It's time and price.